on the currency. Anyway, let's talk.
60-40 is seeing some bit of flows for some time now. Maybe it's not a great deal of time. Maybe for the past week or so, at 60-40 we are beginning to see flows. Market, I guess, is also being pressured by a huge amount of public sector oil companies buying dollars, and I guess this very minor range. It's moving between 60-30, 60-40, largely because I think they want to know how the non-farm payrolls will pan out.
Indeed. So let's talk about that. Arnab Das now joins in from Roubini Global Economics on the line from London. Hi Arnab, morning to you in London. What's your call? I mean, the data tonight, how important is that? And going forward, what kind of reaction would you expect if this data is good?
Well, I think in the short term, the labor market data in the United States is going to be quite important. Bigger picture, what's shaping up as a divergence in economic performance has been for a while, divergence in economic performance and in policy between the United States and the rest of the high-income world. So if today's non-farm payrolls data is quite strong, it will strengthen the impression and clearly the impression that increasingly the Fed is trying to spread in the market that tapering will come sooner rather than later. Even if the data is not that good, the reality is that the U.S. economy is further along in its balance sheet repair. It's structurally more flexible. There's more rebalancing going on. There's been more balance sheet repair in the household sector and the financial sector. There's been more forced recapitalization. And now there's a balance sheet repair advancing in the public sector as well. So the U.S., which went down into the crisis first, is going to come out of the crisis first, both because of sequencing and because of concerted policy action. In contrast, in Europe, in the United Kingdom, in the Eurozone, what happened yesterday was that the major central banks there sent a very clear signal that monetary policy would remain very loose for a long time, which is also the case in Japan. So the discourse in the United States is shifting towards a reduction in the pace of easing, whereas in the rest of the world, it's a continuation of easing. In the rest of the high-income world, it's a continuation of easing. So therefore, what's taking place in the rupee is not so much rupee strength, although that is, rupee weakness, although that is still a factor. This is really the cusp of an episode of dollar strength relative to the rest of the world.
Fair enough. We have seen, of course, dollar Asia becoming stronger, and that had a savage impact about 2 weeks back on the rupee. But Arnab, how will things play out here on? Do you expect that if the non-farm payroll numbers came in stronger, we will have yet another bout of emerging market bond selling and currency risk-off playing out? Or will that substantially get countered because 3 other central bankers are still in liquidity easing mode?
Yeah, I think it'll be not so much a generalized risk-off, so much as a more concerted outperformance of risky assets in the United States compared to risky assets in the rest of the world, and together with that, dollar strength and weakness in many other currencies. And again, that is because that a strong NFP number today will confirm that the recovery is persisting. Despite the onslaught of the fiscal drag that began the first quarter of this year, maybe took some more steam out of the economy in the second quarter, and would suggest that the private sector is healing enough to gradually take over the baton from the federal budget. Then that would suggest eventually it'll be able to take over the baton from the Federal Reserve as well, right?
So what is the lesson for emerging markets like India? What are you expecting? Further exit of foreign funds from bonds and equities? How would you prepare for the next quarter if you were an India investor?
I would be underweight, and steer clear sort of emerging markets. I wouldn't necessarily, panic sell because of a strong NFP number. I think there's been our impression generally is there's been a lot of position squaring and clearing, a lot of clearing of the decks in the recent waves of volatility that have taken place. I think there may be some more knee-jerk reaction like that, and of course one needs to protect oneself against that. But the bigger picture is that the world economy is rebalancing with the U.S. Healing itself, and emerging markets are not doing so well. Right, the growth differential has narrowed substantially. The idea that EM countries were going to catch up in a straight line never seemed very credible to me or to us at RGE. That's come under a lot more scrutiny with the slowdown of China, the slowdown of India, and the ripple effects of that through commodity exporting countries in Latin America, Russia and the CIS, and sub-Saharan Africa. So I think the tide may be turning a little bit against the kind of untrammeled EM optimism that we had for such a long time after the global financial crisis. That's not to say that we're going to have EM falling off the map and entering immediately into a crisis. But we are going to have some adjustments in EM. In India, as in many other countries, China, Brazil, Turkey, Russia, South Africa, so not just the BRICS, but among many large emerging market countries, whether they're surplus countries like Russia and China, current account surplus countries, or deficit countries like Brazil, India, and Turkey, we've had a domestic credit boom, very significant domestic credit boom, and private credit, public credit, and now the economy is slowing down. So some of the problems that have been stored up are going to start to come out.
Fair enough. Just two levels, if you can give me. Do you think the rupee has substantially discounted these negatives, or do you think you will see further weakness in 2013 itself? Also, your view on gold. Is there more to go by way of declines, or are all these other central bankers keeping it hydrated?
I think on gold, first of all, an important part of the emergency has passed that caused gold to be such a desirable hedge against either a high inflation because we try to print our way entirely out of this problem, or a severe deflation because we try to default our way out of this problem of excessive debt in the West. I think what the gold market and participants in it are realizing is that the tail risks have been substantially improved in the United States and substantially suppressed in the Eurozone through the commitments of the ECB. So gold doesn't have much upside. If anything, it has some further downside. It won't collapse probably from significantly from here because nothing in the Eurozone has really been resolved. And as the crisis in Portugal shows us, politics and the social backlash against the policies in place could still resurrect that particular emergency. But at least the U.S. emergency seems to be over. So gold is kind of an emergency safe haven. It's not a safe harbor like treasuries or which is about financial stability. Now, on the rupee, I think there's probably some risk of further weakness. It doesn't seem like the government is willing to intervene very much to stabilize the rupee, which distinguishes it a bit from some other countries that are experiencing currency pressure in emerging Asia. And so, that's good and bad. It's bad in the short term if you're long rupee or rupee assets. It's good because it will help the external adjustment that needs to take place in India, and it will not further damage the public sector balance sheet by running down reserves. So I do think there'll be some more weakness, but not falling out of bed.
All right, Arnab. Thanks a lot for your time. That's Arnab Das. Meanwhile, let's just